Most people will never build real wealth from investing, not because the market is unfair, not because they started too late, not because they did not have enough capital, because they never had a framework. Welcome to the Profit by Friday podcast, where we replace guessing with process, emotion with discipline, and noise with one clear idea every single week. Let us get into it. Marcus Chen is a software engineer in Chicago, 38 years old, 6 years of investing experience, smart enough to do the work, disciplined enough to run every stock through the clear framework before committing capital. In January, he found a stock that scored 88 out of 100, highest conviction. He spent 3 months on the research, annual reports, earnings history, a structural catalyst he believed would drive the business forward for the next 5 years. He bought the stock on a Tuesday morning. By Friday, it was down 11%. By the following Wednesday, it had dropped another 8%. Marcus held. He believed in the thesis. The numbers had not changed, but he was sitting on a nearly 20% loss 3 weeks into what was supposed to be his best trade of the year. He did not sleep well those 3 weeks. He checked the price every hour. He reread his research looking for what he had missed. He nearly sold twice. 6 months later, the stock was up 40% from his entry. Marcus made money. But those 3 weeks nearly broke him out of the right trade at exactly the wrong moment. And he still could not understand why the stock had dropped so aggressively right after he bought it, when nothing about the business had changed. Here's what had happened. Marcus had looked at the right stock. He had done the right research. But he had looked at only one chart, the daily. And the daily chart told him the stock was at a reasonable level. What he had not looked at was the weekly chart. And the weekly chart told a completely different story. The stock was hitting a significant resistance level that had held for 18 months. Every time the stock approached that level, sellers came in and pushed it back down. Marcus walked straight into the wall. This is the two-chart rule. And it is the single most important technical concept for investors who have already done their fundamental work. Here is how it works. Every investment decision requires 2 chart checks before you enter. Not 1, 2. The first chart is the weekly chart. This is your structural gate. The weekly chart shows you the big picture. It tells you whether the stock is in a long-term uptrend, a downtrend, or a range. It shows you where the major support and resistance levels are. A wave set have been tested and respected over months and years, not days. When you look at the weekly chart, you are asking one question. Is the structural picture healthy enough to justify entering a position right now? If the stock is approaching a major resistance level on the weekly chart, the answer is no. Wait, if the stock is breaking out of a long base on the weekly chart, the answer is yes. The structural gate is open. The weekly chart is not about timing. It is about structure. It tells you whether the environment you are entering is working in your favor or against you. The second chart is the daily chart. This is your timing gate. Once the weekly chart has confirmed the structural picture is healthy, you drop to the daily chart to find the specific entry point. The daily chart shows you where the stock is on a day-to-day basis, where it found support yesterday, where it met resistance this morning, whether it is extended from a recent move or pulling back to a level where buyers have previously stepped in. When you look at the daily chart, we're asking one question. Is this the right moment to enter? Within the healthy structure, the weekly chart confirmed. If the stock just ran 12% in 5 days and is sitting at the top of its recent range, the answer is no. Wait for the pullback. If the stock has pulled back to a key support level on the daily chart within a healthy weekly structure, that is your entry. The 2 charts work together. Neither one is sufficient on its own. The weekly chart without the daily chart gives you the right environment, but the wrong timing. You end up buying at the top of a short-term move within a healthy long-term structure. You are right, but your entry is poor. The daily chart without the weekly chart gives you a precise entry point that could be walking straight into a structural wall. You feel good about the timing, but you have no idea whether the big picture supports the move. Marcus had the daily chart right. His timing within the daily picture was reasonable. But the weekly chart had a wall right above his entry that he never saw. And that wall caused the immediate drop that nearly shook him out of his best trade of the year. Here is the rule locked in the framework. Weekly chart is the structural gate. It must be open before you look at the daily chart. If the weekly structure is broken or approaching major resistance, you do not proceed regardless of how good the daily looks. Daily chart is the timing gate. Once the weekly gate is open, you use the daily to find the precise entry, pull back to support, low volume consolidation, a clean setup that tells you buyers are ready to step in. Both gates must be open. Both charts must align. If they do not align, you wait. There is always another opportunity. This is why experienced investors seem to enter positions at exactly the right moment while doing less analysis. They are not smarter. They are using 2 charts instead of 1. Amateurs find the right stock. Investors find the right stock at the right structural moment. The difference is 1 extra chart and the discipline to wait when it says no. Visit Profit by Friday today. I will see you in episode 8.